right? You're enjoying potentially life-changing success.
Most certainly, but I have been around the block a few times. And whenever things have gone this well for me, usually there's a correction.
For the last 2 hours, I'd sat with a friend at the Baja Mar Cigar Bar in the Bahamas. We'd attended as media the FTX SALT conference, a posh cryptocurrency event that would reinforce the pomp and false truths about Sam Bankman-Fried months before his implosion. Across the patio, there was the headline speaker chatting with high-profile money managers. Everyone at nearby tables turned to her, pointing in joy but too nervous to approach. But me, I had to ask a question. As she stood and departed, I walked toward the same patio door. Before I caught up, another man swooped in and cut me off. He started gushing about how much he admired her firm. This guy, he was trying to get a job. I was not. You see, something bothered me about her strategy. So I stood and bounced a few steps away, waiting 5 minutes, 10 minutes, 15 minutes. It must have lasted 25 minutes. But when I finally had the chance to shake institutional champion Cathie Wood's hand, I began with this setup. Wood purchased many tech stocks while the markets pulled back in 2021 and 2022. She called these beaten down names value stocks. Now, I'd just written a piece in Luckbox magazine exploring her portfolios and asking one critical question. If corporate executives, CEOs, CFOs, chairpersons at those same companies weren't buying their own stocks at the same prices she paid, then why was she buying them in the first place? In 2020, Wood's firm ARK Invest had 5 of the top 7 performing ETFs in the markets. She's headlined conferences, she's praised in Bloomberg and gushed over CNBC. But since February 2021, the ARK Innovation Fund has dramatically underperformed. Shares have plunged from just north of $159 to now about $39. It bottomed at around $29 last December.
I would not be surprised to see the Fed cut rates this year.
Wood has said that we should all wait 5 years and recently suggested the Fed would soon cut rates, helping her positions. That's a slight admission that monetary policy is a boon for the strategy, which relies on rising global liquidity chasing risk assets. We can't say that 2020's market rally or ARK's performances was based on fundamentals. After the Fed dropped trillions from the sky and Congress paid people to stay home and day trade on many of the same names inside various ARK Invest ETF portfolios. Wood's fund has a thematic approach that doesn't seem to be very quantifiable and questionably qualitative. The central argument is that the company she owns will be disruptive and the best in their industries. She focuses on AI, 3D printing, and genomics, all bleeding-edge tech. But the strategy does rely on a preternatural ability to pick the right company from a sea of disruptors, IPOs, and more. Now, I credit Wood because she does all of this out in the open. She's using an exchange-traded fund, an ETF, which trades on the equity markets and displays all of her buys and sells daily. This is an active trading strategy, and it's not like a private fund that doesn't have to mark to market each day, or a hedge fund that doesn't report its purchases or moves every 90 days. It's all open, inviting praise and criticism based on market conditions. But back to my original question. Wood isn't using equity momentum or liquidity readings she doesn't hedge much, if at all. That is what I'm willing to dismiss. She might not believe in technical analysis and might be more focused on the Fed than our focus on global liquidity, which is all central bank activity, private credit, and cross-border capital flow. What I can't dismiss or comprehend is very rational to me. There's a complete avoidance of following the most important and strongest financial anomaly, insider buying activity. As I've asked, if the CEO or CFO isn't buying the stock at Wood's buying levels after a pullback, why is she buying? My original question delivered this analysis in Luckbox. As I noted, ARK shares peaked at $159.70 in February 2021. Executives at the top 10 companies held by the ARK Innovation Fund sold nearly $28 billion in shares from February 2021 to February 2022, while the ETF cratered, according to SEC forms. Outside of the largest holding, which is Tesla, the remaining 9 represented about $11 billion in executive selling. Now here's the punchline. over the next 12 months, how much insider buying happened at the top 10 companies while their stocks fell from February 2021 to February 2022. Your options are 1, 0, 2, zilch, 3, nothing, or 4, all of the above. Any of those answers will do. I hadn't thought much about this research until this morning. I came across a headline on Yahoo Finance via TipRanks, a platform that tracks Wall Street analyst forecasts. It read, "Too cheap to ignore. Cathie Wood snaps up these two stocks under $5. The writers didn't interview Wood, but they did offer a recent quote of her pushing the narrative that her stocks will do quite well if the Fed starts cutting rates. But that timetable keeps getting pushed out months and months.
But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And we are ready for prime time.
Well, let's look at those names in Yahoo Finance. The first stock in the story is Velo 3D. VLD is the ticker, an additive manufacturing company in the metal 3D printing industry. The second stock is Ginkgo Bioworks. DNA is the ticker. This company, quote, specializes in synthetic biology and genetic engineering. But keep in mind that the headline says these stocks are cheap. Just because they're under $5 does not make them cheap. Fundamental analysis can tell us if a stock is or isn't cheap, and if a company's unprofitable or has a high price to sales ratio over 10 or its enterprise value to EBIT is over 20, I assure you it is not cheap. Velo 3D VLD is unprofitable. It has a 14% short float. It lost more than $100 million last year, and it's still trading well above its book value and cash per share value. There's nothing attractive about it unless you're a speculator in, quote, producing custom microorganisms, whatever that means. Meanwhile, Ginkgo Bioworks is also unprofitable. It lost $1.25 billion last year, and it trades at 10 times its sales or revenue, meaning it would have to pay investors 10 years of revenue, every dollar in the door, not profits, to justify its valuation. Once again, $5 doesn't make something cheap in our world. But let's look at something more substantial. Are the insiders buying DNA or VLD? Well, the answer is overwhelmingly no. They've been selling all year. This is a breakdown of insider buying and selling activity at VLD over the last 5 years. The blue line is buying and the red line is selling. There are no blue lines and recent selling over the summer. And Ginkgo Bioworks? Well, get ready. Oof. Look at all the sales over the last year. There's only been one purchase, and the selling to buying ratio is a stunning 160 to 1, dollar for dollar. Now, I will acknowledge that many executives are paid in stock and take money out of the market, but if the stock gets cheap in their eyes, I assure you they will buy it, or they could at least hold on to their shares and look for appreciation to the upside. So it begs the question, if they're not buying, why would you? Again, in negative momentum with no insider buying, always ask, if the executives aren't buying a stock, why would I? And if your answer is that you read a Yahoo Finance article or saw it on CNBC, run, don't walk from that name.